Well, hey, everybody. Welcome back to the channel. Have you ever wondered how to short sell shares? I have to say it slow because that is hard to say. You say it too many times fast. It's like a tongue twister, right? So in this video, for the next 15 or so minutes, I'm going to share with you how do you short sell shares. This is a seller strategy that is not usually talked about too much because generally people are talking about options. But this is another seller strategy that we use in order to create consistent income. Hang out with me, okay? I'm going to share with you exactly how to short sell shares. And I'll see you at the end. Short selling looks like this. This is our graphic here. When you're shorting, you're basically thinking that the stock is here. So when you're up at the top here, you're going to sell short, believing that the stock price will go down. And at some point here, you buy it back. And then you hope that you've made money in the meantime. And this difference between these two is your money. Selling short with shares is just like us selling verticals, where we sell to open at one price, the premium we hope goes down, down, down. And when we buy back at our 0.01 or 0.05 or whatever it is we buy back at, we're buying back at a lower price. It's the same concept, except for now we're talking about shares instead of options. All righty. I want to make sure that we're clear on that. Now, almost everything we've talked about up till now in all of our strategies, we've talked about options. This is the first time we're talking about a strategy where I'm talking about just shares. So you're saying, I want to short sell 5. I want to short sell 10 shares. It's not the whole options contract, okay? It's just the amount of shares that we're shorting. You're going to enter short thinking it's going to go down, and then you buy it back at a lower price. All righty. Short selling is when you borrow shares from the broker. You sell them at one price and then you buy them back at a lower price. I really just said that. And you keep the difference in price between those two things. Shorting is basically the opposite of going long. Usually when we buy shares, you expect to buy them at one price and have the price climb, of course, and you can sell them higher and keep the profit between those two. That's what we usually do for buying stocks. Shorting is just doing the opposite of that, where you're selling it at a higher place, believing it's falling or knowing it's falling, and then as it goes to a lower price, you buy it back. And then basically return it back to the broker because you borrowed the shares. Here's a graphic that kind of shows you the steps. Okay, step 1, you borrow the shares from the broker. Step 2, you're going to sell the shares to the market at the price that you're choosing or the price that you're entering for. Step 3, what you hope to happen is as the share falls in price, you hope the price goes down. When you're shorting, right? And then step 4, you buy back at a lower price and return the shares to the broker. And you keep the difference in money is step 5. This is just like us selling call credit spreads or selling put credit spreads. We are sellers, so this is just like all the seller strategies that we use, except for this one is using shares instead of options. Generally, we use options. When would you short sell? You would short sell when you believe the price is going to be going down. So this past week, we've had several opportunities for short selling because stuff have just been going down. What you do see sometimes if things are going down too much, the broker will change the stock to hard to borrow. Either HB or HTB, you may see next to a stock. So we will see that on their option chain, on their trade page. When you look at it, it means the broker's not wanting to lend those shares because they see that prices are probably going down in that area. You also will short sell when you want to do increments of shares that are not necessarily 100. Of course, when you're doing options, we're doing 100 at a time. But when you're short selling, you can short sell 5, you can short sell 3, you can short sell, 80. let's say you don't want to do a whole 100, you just want to do a portion, or you can do 150, some increment of shares that is not in increments of 100. You can do that with short selling. You also would short sell when you want to hedge a losing trade, like a leap, or if you have long shares. Let's say you have shares, we do, of SoFi that you might have bought at $13, right? And those shares are now down. You could sell SoFi or whatever short and make money on the downward ride while you're holding stock that you were hoping to go long, right? You can do it with a leap, which many of us have leaps that are in the red. You can do it against a leap. You can do it against shares. Like if you have shares and those shares are now red, which almost everything you got now is probably red. You can sell short with those shares. Short selling gives you dollar for dollar. So if the price moves down $1, you make $1, right? So if the stock price falls $2, then you make $2 per share, which is different than options, because options, you're going to make your money based on the delta being involved. So if you've got a 50 delta and the price goes down $1, then you're only going to make 50 cents per share. There's a difference between shares and options. With shares, it's dollar for dollar. If you buy it at $10 and it goes up to 11, then you've made $1. But for like a option play, if you got in with a 10 strike and you have a delta of, let's say 50 again, and you get out at the 11, then you've only made $50. You've not made dollar for dollar. Okay, that's one can be a plus or a minus, because if you're losing money, you're also losing dollar for dollar, right? You can short sell when you don't want the time expiration. Good thing about short selling is that you don't have time expiration. With the options play, you got an expiration date, and something needs to happen between now and the expiration in order for you to get whatever it is you're going to get. But at expiration time, all bets are off. Well, when you're short selling shares, you basically have until you return them. Okay, you can also short sell when you don't want to trade as an options play. Maybe you just want to do the shares and you don't want to do it as an option, but you believe, because options takes a whole nother level of involvement. You're not an options trader and you're just a seller, a buyer and a seller of stocks, then short selling would be great. How do we short sell? For example, you borrow 10 shares of an ABC stock from your broker and you sell it for $100 each to the market. So you sell them at $100 and you buy them back to the market for $80. Then you keep the difference between those two, which is $200. So you had 10 shares, you sold them for $10 each, which was $1,000. You buy them back less, at a smaller amount. So you buy them back for $80 each. The difference between these two times the 10 shares gives you the $200 that you keep in your difference of money. You can also have borrowed a 10 shares from the ABC stock and sold them for $100, and the price goes up to $125. If you sold it to the market for $100 each, but the price goes up to $125 and you buy it back, then the difference between these two numbers, the 1,000 and the 1,250, is a $250 loss, because the price didn't go up. Didn't go down, sorry, it went up. What's the cost of short selling? Because of course, nothing is ever free. Nothing is ever free. Okay, since you're borrowing shares, There will be a fee for that. Each of your brokers is going to charge you a fee. We're going to talk about, you need to have margin, but they're going to charge you a little fee. I believe it's very small, so it's not like borrowing shares is not an expensive endeavor. It's very, very cheap. Short selling does impact your buying power if you're shorting against an option. But if you're shorting against a lead or an option contract, the broker is going to, what I've seen is about a $500 impact. And I'm not sure what that number is based on. I've looked at like examples with different shares, with different prices and different things, and I still see the same amount is what's showing up as far as the impact. So I'm not sure how the amount of the impact is figured for how much. I'm not sure how they figure that. So we got pros and cons. The pros and cons of short selling. The pros are, you can make pretty decent profits. It's a higher risk trade or play, so the rewards are higher. Anytime you have higher risk, you're going to have higher rewards, which also means higher losses, which is one of the cons. You can have the possibility of high profits, but you can also have the potential of unlimited loss. All righty. I don't know if anybody ever saw the movie, I want to say, not Tom Hanks or Brad Pitt, one of them, is one of those guys that it was called The Big Short. If anybody's ever watched that trading movie called The Big Short, where he was shorting all these shares and shorting all these stocks, and then it took him a long time, and then they finally made the margin call. But if you hadn't seen that, it's a good movie. It's an older stock market movie, but you'll like it. Another pro is there's not a lot of initial capital required as far as your buying power need to be involved. The con is that you do need a margin account. Your account needs to have margin on it, because the fact that they're potentially lost, the potential to have limited losses, unlimited losses. The pros is that there's leverage investments are possible. And the cons is that margin interest is incurred, so you're going to pay a fee. Pros is you can hedge against other holdings, like we're talking about. You can hedge against shares that you already have that are maybe not going the way you want. A drawback is short squeezes, and I will not go into a huge definition or explanation of short squeezes, but it's basically where you got all these people who are trying to short, and somehow the prices, other people still drive the price up, so that way you have to let your shares go as a short person, as a short selling person, not a short person, as a short selling person, you have to let your shares go, and there's a squeeze basically to squeeze out the short people. So if you're selling short and a bunch of people are driving the price up, and a good example that comes to mind is AMC. Folks thought AMC was going to fall, so they started shorting it, but a bunch of people started buying AMC and holding it. So that basically meant that drove the price of AMC up. These people who were holding short sales, basically you either going to keep paying for your short sales and wait them out, or you have to pay up here to buy back at a higher price and lose your money. It's called a short squeeze. So when does short selling go wrong? Well, your loss is infinite. And the reason I say it's infinite, let's say, for example, you decide you're going to short SoFi at $10, right? Or we can use Palantir yesterday as an example. Potentially somebody was shorting Palantir yesterday or the day before and thinking it was going to stay around the $9, $10 range, and Palantir starts running up. Well, there's no, stocks don't go up forever. So there is a top up there, but you could be shorting something and it could just run up. And all that extra money up here is stuff you got to pay. It probably would be more of an impact to you if you were doing something like, let's say you were shorting an Amazon. If you were shorting Amazon at, I would say $3,000. And then it ran up based on something to $3,300. Well, that's $300 per share. So depending on how many shares you were shorting, that's how much money you're going to have to pay. All righty. So your infinite loss is a possibility, which is probably why the brokers want you to have margin. So they can cover it if possible. And then they go, of course, make you pay when they do the margin call. If the price goes up and up and up, you're losing money with every increase. Because remember, shares are dollar for dollar. So if the price goes up 50 cents, that's 50 cents of loss per share. If it goes up $1, that's $1 loss per share. If it goes up $5, that's $5 loss per share. If it goes down, then that's a great thing. But it can go the way in an opposite direction from you. Definitely want to have a stock market or something in place that's going to help save you from yourself. You have to have a margin account in order to short sale. As you borrow shares, you're going to pay fees to the broker. If you're interested in shorting, just know there's going to be a small fee associated with it. And if lots of people are shorting, you could have trouble buying back at your desired price. Okay. The one way you can avoid this is by only shorting stocks with a very high volume. So if you want to make sure that something has a lot of liquidity, that's one way you could kind of help yourself with shorting. Make sure that it's liquid, because you don't want to get where you shorted something down $1 and you get to the dollar amount that you want and try to buy it back, and there's no way to buy it back. You don't want that either. So you want to have a lot of volume and liquidity to make sure you can buy back at the prices you want. So here are the steps to shorting. First, you want to identify a stock that you think is going down. Now, this is a little bit different than what we do for call credit spreads. With call credit spreads, we don't need the price to actually go down. We just need it to stay below our strike. If you're shorting, you want the price to go on and move on down. Then you want to chart for resistance areas for your entry. You want to enter at a resistance place or a sell zone. You want to enter at a resistance area or a sell zone, believing that price is going to go down. Ahead of time, you should decide your exit price. We know better than to just jump in, hoping for the best, and don't have no kind of way of when we're going to get out or how we're going to get out or how much money we're going to take before we get out. We need to have thought about that ahead of time. So if you decide you're going to short SoFi for $1, then you need to say it's at 10.50, and when it gets down to 9.50, I'm getting out. Don't decide you're going to figure that out after the fact. No, ma'am, or no, sir, because it's not only ma'ams. Let's make sure you think about that ahead of time. Okay. Then determine how many shares you can afford to borrow. How many shares can you afford to borrow? If you've got shares that you can cover with, you can use as many of those as you want. If you don't, then you need to see what's the cost going to be, the impact on my buying power for me to short sale. That way you can decide. Maybe 10 shares is all you want to do. Maybe 20, maybe 50, maybe 120. It's up to you, but you just want to make sure that you know how many shares you can afford to borrow or use to short sale with. Then you're going to go to the stock on your particular platform. Just so we know, Robinhood does not offer shorting. I looked, unless somebody sees something I don't see. When you go to the page for the stock, there is no sell option. There's a trade options or buy. There is nothing that says sell. You can't sell. There's no choice for selling. Maybe go back to that whole thought about them not having margin accounts either. So you go to the stock, you pick trade, and you sell to open. And then you need to be prepared to buy to close. Maybe you go ahead and put in your order of where you're going to buy back. Say, I'm buying back at so-and-so price, and you put your order into where you're going to buy back as soon as you enter to get into short sale. Real quick, I just wanted to come on. This is Arlissa, Educator to Trader. Wanted to come on and tell you and ask you, I guess, to like and subscribe to the channel. If you like the content that I create and I'm, posting regularly, then go ahead and subscribe. That way you won't miss anything and you can be a part of all that we're doing here. I'm a coach to sellers. I'm an option sellers coach. If that's a vein that you don't know anything about or you want to know more about, then go ahead, subscribe and check us out all the time. All right. Thank y'all. I appreciate it.